Let's talk about real estate investor loan options, different ways that financing strategies can help build and scale your portfolio. We're going to talk about single family residential, which is your standard, home, one kitchen, one home. You have duplexes, quadruplexes, you can go up to 16 units. Actually being an investor, we can help you with financing those. Mixed use properties, which are basically um, residential properties with some commercial space above or connected to it, and even new construction for investors. So why your financing strategy matters is this: the right loan increases your purchasing power. So and your cash flow. So your cash flow is what you really care about as an investor. How many properties you're looking to purchase and diversification of your loan portfolio. So do you want to buy all single family homes, or do you want to combine that with some multifamily units, some duplexes, some quadruplexes, or do you even want to add some condos in there? Are the condos FHA Fannie Mae approved, or are they non-warrantable condos? All those things matter. Conventional investor loans. This is the traditional way that investors get qualified. You're going to put down 15 to 20% down. It's going to go through Fannie or Freddie Mac, or some private banks. You get great interest rates. So you're going to get the market rates for investors. They're not going to be as low as someone buying their primary residence, but they are going to be pretty good interest rates. You can get renovation and solar and energy options available with that. What I'm saying, so you can go a Fannie Mae Home Ready, or you can do the Freddie Mac programs, and you can do renovation on those properties. You can add in high vacs, your air conditioning systems, roofs, some appliances, and those things. You can add those into the loan so that your home is renter ready as soon as you buy it. You also have the solar energy products that are available, which can help your renters and yourself with renting that home. It's going to keep their utility bills down. Pros and cons of conventional loans. Again, you're going to get lower rates, but it's fully documentation required. So what that means is we're going to need your personal tax returns, your business tax returns if you have a business. If you already have rental properties, we're going to need all those schedules. So that means you can't just send over like part of the tax return, or I just make this W-2. We do need to see all your income. You're going to have to qualify for both your current residence and the investment properties that you're buying, and all the ones that you currently own. So that's where, if you already own properties, we do need to see the rent schedules to make sure you're being profitable on those. So some people have a low debt to income ratio. The first one or two properties isn't a problem, but as you go along, getting more properties, you may be writing off a lot of the income. So that's when it becomes an issue with going full doc. You could also put down as little as 15%. So you could put down 15%, go conventional. You still would have MI, or you could pay the MI up front. But anything less than 20% would require mortgage insurance. Next are bank statement loans. These are some of my favorite. If you have a lot of income, but you write all your income off, basically. You make $100,000, $150,000 a year, but you write it off to $40,000 a year. And it doesn't show that you make enough income to afford your primary residence, nonetheless, some investment properties. So the thing about bank statement loans, you do have to prove that you've been self-employed for at least 1 year. It's more of a credit-driven program, and there's no need for your tax returns, especially if you have complicated tax returns. And we can go down to a 600 median score. When bank statements loans work best, again, if you're self-employed, or you're a maybe not you're self-employed, or you're 1099, you cannot have your own company, but you could be a contractor, you could be an actor, you could be a DoorDash person, you could be a landscaping person, you could be a model, whatever it is that you don't get an actual pay stub, and or how you get paid doesn't show enough income for you to qualify for the property. So you can use your personal bank statements. You can do 12 or 24 months, or you can do business bank statements 12 or 24 months. Some banks will even allow as little as 6 months. The thing about bank statement loans, again, you probably do have to have some reserves available. What reserves are basically showing that you have enough still saved after the down payment to show that you can pay the mortgage for 2 or 3 months if you don't happen to get a renter in there. DSCR loans, these are like really the most popular thing out there right now. Lenders like to do them. It's less paperwork for us. It's a lot less paperwork for you. You qualify based on the rental income of the property. So just take a standard single family residence. If you see that house in that neighborhood rents for $2,000 a month, and rents for $2,000 a month, you get pre-approved for a mortgage on it, and your total mortgage payment, tax, insurance, and everything. If there's HOA is going to be less than that $2,000 a month. Say it's going to be $1,500, then you qualify to purchase that home. You just have to come up with a down payment, and that's it. So it can, depending on the bank, if it's somewhere that has a lot of Airbnbs, you can use that short-term income. That as long as you have proof that you can show it, or they can show an area, they do have Airbnb charts that you can get that information, and it'll show how much you would make off of that. Or you can use long-term leases based on what the appraiser has. Or if you're buying a property and already has a renter in it, you can use what you've been making on rent for that. Basically, the property pays for itself, and then you're good to go. Why investors love DSCR loans: fast closing, scalable portfolios. So since it's not based on your personal income, you could own 100 of these as long as each of the properties are paying for themselves and you have the down payment to get into the properties. You qualify using the current market rent, as we discussed, not your personal income. You can even get a gift for down payment with some of the investors that we use. So again, a lot of less paperwork. That's the biggest thing, and you can close faster. Investor renovation loans. So if you're someone and you're interested in buying fixer uppers, we finance those, so you can find properties at a lower price. That's one of the biggest benefits. So whereas if you get that property, it might be 250,000, 300,000, all fixed up and ready to go. You go in and get it for 100 grand, and it needs another 100 grand, $100,000 in renovations. We can finance all the renovations and up to 10%, and you can put down as little as 10%. Whereas if you just go buy that property was already move-in ready, you'd be putting down 25%. So again, it's good for experienced investors. Once you do 2 or 3 within like a 12-month or a 24-month period, then you're considered an experienced investors. And some of the people will even finance to 100% of the project if they think the after appraised value is going to work. Ground up construction loans. A lot of people don't think about this. We do offer this. These are you're going to build to rent. So if you say I want to do a duplex or a single family residence, there's a lot of builders out there actually building communities for build to rent. So basically you would go find a lot, build a home on it. And if they look at it and they say, hey, this is how much the house is going to appraise for in that area, this is how much you would rent for, then you would be good to go. What you do on these loans is you do have to put down the down payment at the beginning. And then at the end, you would just pay the taxes and the escrows due on the home. During the meantime, while the home is being built, then you do have to pay the interest-only payment on it. So their first draw was $50,000 to pay off a lot. Then you got another draw for $50,000 for the builder to start. Until they got a new draw, you would only be paying an interest-only payment on 100 grand while that was going on. So that's how that works. Once the home is completed, it would just roll into a 30-year term, and then you would just pay that monthly payment. You would have to prove that you have the home sold or that you have a contract on it, before you get to the end of the process. And this is good because you can customize rental properties to meet your market. If you're in a market where you need smaller homes, you can build smaller homes. If you're in a market where you need to build multi-generational homes or it's more expensive rentals, you could do that. You could do quads. You can do a lot of different things. Which loan is right for you? Again, this is based on your strategy. Are you going to close in your personal name? Are you going to create a new LLC for each home? Are you using an LLC or partnership? Is it not just you in this corporation that's going to purchase the home? Or maybe even, do you need a no-doc program? Do you just have a lot of assets, but you don't have any? You have a lot of assets, and you have good credit, but you have no rental history, or you may not even currently own a home. We have options for all of that. The other thing, the most important thing, is work with a lender of experience. I've been doing this for 30 years. I've seen all types of credit, all types of income and everything. I'm going to put you in something that's going to make it easier for you to close, and it's going to be beneficial for you. Also going to give you options for multiple loan products so you can make the best decision for your business. You may not want a 30-year term. You may want a 40-year term. Another thing is, if you say, hey, we're going to rent these out for 5 years and then we're going to sell them, maybe you want to do an ARM. You'll get a lower initial interest rate, to be fixed for 5 years or 7 years. And then because you're going to sell it, you want to go ahead and get as much rental income out of it, and then sell it. That's an option. Last thing, multiple loan terms. You don't have to do 30-year loan. You can do a 40-year loan. You may say, hey, we want to pay these off quick. We want to do a 15 or 20-year loan. So those are all options we can show you. And then someone just to make sure they can explain all the options, let you know so that you can make the best decision for your business. Your next step is, if you're interested, you can contact me at my email here, reggie.graham@cardinalfinancial.com. Call or text me. That's my direct number, 404-461-3172, or apply at reggieloans.com, or call me in the office, 980-246-8774. Hope this helps, and I look forward to working with you.